All right. Hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our midweek options update. We've had a very interesting start to the week, a lot of big moves back and forth. We really haven't seen a whole lot of follow through, which we'll talk about in just a moment, but it is another active week. A lot of good volume, a lot of good moves intraday to work with, and I'll walk you through what we've been doing on our side, specifically with our overnight pop trades. Those continue to perform really, really well for us. We'll walk you through the trades that we put on yesterday afternoon. And then I'll also highlight a couple of markets that are jumping out at us for potential trade opportunities for the rest of this week. So let's go ahead and dive in. As always, if you have any questions throughout the session today, feel free to type those into the chat box. If you're watching the recording, please post a comment on the video. If you have any questions, I'll get back with you right away. Or you can always email me directly. Mike@netpicks.com is the email address. So coming into this week, a lot of talk about the moves in the bond markets. Over the past week or so, the move in rates has really dominated price action. And we've seen equities trading based off of what we've seen in the bond market. That continues this week. We have some nervousness coming in. We've had some weakness specifically in the Nasdaq. We've talked about this for the last number of months with our students, really going back into last year. We get a lot of sector rotation. We don't get a lot of those moves where all of the index products are moving together, where all of the sectors are moving together. There's always that one or two strong sectors that prevent any type of significant weakness from kicking in. So right now we've got the Nasdaq, which is absolutely lagging behind. We continue to see strength in energy. We continue to see strength in the financials. Those two sectors are preventing any type of washout move from the downside to happen from the downside. So what's going to be interesting the rest of this week, we got that tug of war going on. Is one side going to win out? If we look at historically what has happened when we get this tug of war, we continue to see the baton pass from one sector to the next, and we continue to see the market hang in there. Based on that assumption, we could very well see the Nasdaq start to bounce here in the days to come and start to see some weakness in energy in the financials. And if that's the case, we'll continue just to see that that game of musical chairs continue until we get one of those moves where every sector is participating, every index is participating. We're going to continue to see the chop kick in, and you'll see what I'm talking about on the daily chart of SPY. We have had some pretty big movement intraday over the past week or so. I mean, you should look at the sizes of the candles over the past a week and a half, 2 weeks, compared to what we saw on the upside early in February, even going back into January. You can see the sizes of these candles have just expanded. We're getting better range intraday. That's a good thing, right? On the downside, if we take a look, we just get this Christmas tree formation setting up. Right? We just get that back and forth. We got a lot of red, green, red, green. There's not a lot of follow through here. We've just been pinned in between 380 and 390. Okay, we've got the 50 period EMA on the downside, which is acting as support. And on the upside, that 390 level has been like a brick wall. We have not been able to break up through that level. Until one of these levels breaks on a closing basis, we're going to continue to see more noise and more chop. If we break it to the upside, the all-time high is at 394.17. It could be a very quick move up to that level should we break 390. There continues to be talk of SPX or the S&P 500 hitting 4,000. It's very possible. We continue to hear rumblings of more stimulus. There's still negotiations going on and what it's going to look like and so forth. But if they continue to pump $2 trillion into the system, obviously that's a big tailwind to the market. If we start to break lower, if this Nasdaq weakness gets nasty into the end of the week, if we break down below the 50 EMA, the next level below us as support is not down until around the 370 level. There's a very big air pocket on the downside. That's why the bulls are doing everything they can to prevent any type of significant weakness from kicking in. Now, what's interesting about today's session is we haven't really had any type of big bounce off of the lows in the Nasdaq. What we have seen in the previous number of months, anytime you get weakness in the Nasdaq, it lasts for a couple of hours at a time, and then we get that buy the dip scenario to kick in. We aren't getting that today. That's very interesting. I'm going to watch it closely going into the close today, this afternoon. Do we get that afternoon rally, or is this the session that changes everything here in the near term, where we start to get that selling into the close? The volume is pretty darn good. Here we are at 1:30 Eastern time. We've got a couple hours left in the session, and we've seen 60 million shares trade on SPY. That's a pretty good number. On the move to the upside, it was a struggle to hit 60 million shares at the end of the day. We've already hit that just after midday. So very good volume today. The volume has been very good over the past week and a half. Makes sense as volatility has started to pick back up. Speaking of volatility, the VIX is back above 25. It briefly got above 26. Today just continues to show there's uncertainty in this market. There still is some fear that's being priced in. Now, we really haven't seen that reflected in a big move to the downside as of yet, but the VIX is clearly showing that there is some uncertainty out in the market right now. So we'll see if that plays out going into the end of this week, into early next week. We do have some pretty big news events over the next couple of days. I believe we've got the Fed chairman speaking tomorrow. We've got the ongoing saga with the next stimulus plan. So there's some events here that could potentially move us going into the end of this week. So I do expect it to remain pretty active over the next few days. I would continue to look for a deeper pullback. I would love to see a deeper pullback before our next wave higher. If we're going to see a sustained move up to the all-time highs or even up to 4,000 on the S&P, we really need to see a deeper pullback, in my opinion. We still have way too many stocks that are overbought big picture. All right, so cautiously looking for a pullback this week. Again, I mean, it's encouraging to see some red on the screen, but the follow through is the missing piece. That's what we're going to be looking for over the next few days. Let's go on over, take a look at our overnight pop trades that we put on yesterday afternoon. We're going to start out with our ETF trade, our ETF option superstars trade. We sold an iron condor here yesterday afternoon. We typically put these trades on in the last 30 to 45 minutes of the session, trying to take advantage of the late day volume that kicks in. It also allows us to see, do we get any false breaks? Do we get any false moves intraday? Well, what we are expecting, because we've seen some pretty big moves to start the week, I was expecting more of a choppy session here today. And as a result, instead of trying to put on a directional bullish or bearish trade, we put on a neutral trade. And what that looked like is I sold the 393, 395 call spread, meaning I'm selling the 393 call and I'm buying the 395 call at the same time. And then I sold the 385, 383 put spread, meaning I'm selling the 385 put and I'm buying the 383 put at the same time. An iron condor, I know it's intimidating just due to the name of the trade. You're trading 4 options at the same time. It seems a little intimidating. The whole goal here, it's actually pretty simple in what we're looking for. All I want here on this trade is for SPY to trade in between the strike prices of the options that we sold. I want price to stay in between 385 and 393. I don't care if the stock moves up, down, or sideways. It doesn't matter. As long as price stays below those two numbers, we can make money from the options getting cheaper. The options are going to get cheaper because we're close to expiration. These options expire at the end of the day. The time decay is extreme. These options are going to lose value pretty quickly if the stock price stays in between 393 and 385. Well, if we take a look, these trades are trades that we typically like to close out in the first 60 to 90 minutes of the session on expiration day. Here we are in the afternoon, and we still have the trade on. Why? What gives? Take a look at the price of SPY. We are currently sitting at 385.17. It's kind of bouncing back and forth in here. We are right on top of our lower break-even point. If SPY did nothing but sit right here for the next few hours, that's okay. Any type of a move higher would benefit us. The only move that we don't want to see is a big move below 385. We want price to stay right at 385 or higher. If that happens, we are going to be able to book a profit over the next few hours. We sold the spread yesterday afternoon. We originally collected 48 cents, $48 per spread. It tied up $152 of our capital per spread. Very reasonable trade regardless of account size. It's not a lot of risk on the trade. Well, we came in to this trade looking for more of a neutral outlook. The market really has not been neutral today. We've actually seen some pretty big movement. The S&P right now is currently down. If you take a look at SPX, we're down about 12 to 13 points. SPY is down about $1.30. So we have not had that neutral type move that we were looking for. And yet here we are going into the afternoon session, and we're only down 6 cents. We're down $6 per spread. I love to use the credit spreads. The reason why I continue to cover these credit spreads so often in our midweek update, in our weekly recaps. These trades are very forgiving. When you start to get a chart like this, where you get a lot of back and forth movement, a lot of chop to kick in, the credit spreads can be very user-friendly. They are going to allow us to make some money, even if the market doesn't show those big directional moves. So again, here we are dead wrong on the directional outlook, and we're only down a few pennies. If we get any type of afternoon rally, how many times have we seen that afternoon rally over the past few months? It happens like clockwork, right? If we get any type of a push higher here, because we're getting so close to expiration, this spread could go into profit very, very quickly for us. I'm still looking to close it out before expiration. I will not hold this trade into the close. I will close it out before 4 o'clock. And I'm looking to book a partial profit. Originally, we were targeting between 50 and 75% of the max profit. The max profit being whatever we collected to put on the trade. We collected 48 cents. My goal was to buy it back for between 12 and 24 cents. Probably not going to get all the way down to 12 cents. Probably not going to be able to book the 75% max profit on this trade, but I am still looking to book a partial profit. And in order for that to happen, again, we would need a small push to the upside. We would love to see price stay above 385 over the next few hours. So I still have this trade on, looking to close it out for a partial profit here over the next few hours. The second trade that we put on, this one was put on with our overnight pop trade service. This is the one that we've been talking about so often here recently. And what we did here yesterday afternoon on this one is, instead of selling both the call spread and the put spread, we just sold the call spread. We stayed directional. We were looking for a pullback on this specific trade, and we sold the 390, 392 call spread. Meaning I am selling the 390 call and buying the 392 call at the same time. This trade was put on right around 3:30 Eastern time yesterday afternoon, about 30 minutes before the close, trying to take advantage of that bigger volume. And we closed this trade out within the first couple of minutes of the session. We opened the trade yesterday. We ended up, I'm going to get my exact fill price. We sold it for 54 cents. We collected $54 per spread. It tied up around $146 of our capital per spread. Again, very reasonable. If we're dead wrong, that's why I love these trades. If we're dead wrong, I know what my maximum loss is. It's a defined risk trade. I can't lose more than that $146 per spread. The goal of this trade is I wanted SPY to stay below 390. That was the strike price of the option that we sold. Any type of a move lower would help me. A move sideways, I would be okay with, as long as price was below 390. And any type of a move higher, as long as it's below 390, we were okay. We also made money from time decay adding up, which it did because we're so close to expiration. And we made money if volatility decreased. Well, what happened today? We had 5 ways of making money. We had a number of factors line up. First of all, price stayed below 390. That's a big deal. Volatility didn't contract. Volatility has expanded. So we didn't have volatility helping us with this trade, but the directional move and the time decay really helped us. And we were able to close out of this spread. We actually closed it out for 15 cents this morning. That gave us a $39 profit per spread, which doesn't seem very big at initial glance. That was a 27% return on our capital overnight. We opened the trade at 3:30 Eastern time yesterday afternoon. We closed this trade out essentially at 9:31 this morning. So we're in and out in less than 24 hours. Defined risk trade, 27% return on our capital. And this is trade 11 or 12 in a row on the profitable side. We've had 11 or 12 winners in a row here. These are trades that we continue to use to generate a consistent source of income each week. Doesn't mean we're going to win on every trade. We are absolutely going to have losing trades. It's going to come. We just happen to be in a very nice stretch. Markets have been very active for us. This can be a great complement to some of the other type of trading that you're doing. If you're buying long calls, long puts, if you're looking to put on more of a longer duration trade, I'm not saying you should abandon that approach, but this can be a great complement. It can generate a near-term source of income while you're waiting for some of those longer-term positions to play out. Okay, now you can see on the quote screen down at the bottom, this spread is currently traded for 2 cents. I closed it out for 15 cents. Had I held throughout the day, I would have been able to book an additional 13 cents of profit, $13 per spread. Why wouldn't I hold? Well, we've talked about this here the past couple of live webinars. Hindsight as a trader it's always difficult to deal with hindsight because hindsight's always 2020. We can always look back and say, we should have done this and we should have done that. As of the opening bell this morning, we were able to book a really nice profit between 50 and 75% of the max profit. I wanted to close the trade out to avoid any type of rally, any type of buy the dip. How many times have we seen that? We get some overnight selling, we get a lower open, and then the market rallies higher the rest of the day. We've seen it happen over and over again over the past few months. So I wanted to book the profit and not get caught by a buy the dip, because if they would have bought the dip and if price would have gone back above 390, I would have gone from a nice profit to a loss pretty quickly. I wasn't willing to take that risk. I was looking to book my profit as quickly as I could here today, book the profit, free up the capital for the next round of setups, and also free up my day so I don't have to sit there and watch every tick back and forth. If you still have the trade on, that's fine. Price has stayed below 390. As long as price stays below 390 into the close, you could hold and book the entire profit. Just let the whole spread expire worthless at the end of the day. Not an approach that we will typically do on our side. I'm going to say 9 times out of 10 at least. I mean, it's almost 10 times out of 10. We're going to close the trade out early. We're not going to hold into expiration. Not in this market when we have just seen so many crazy moves late day. I just don't want to get caught where we're profitable all day long and then give it back up in the last 30 to 60 minutes of the session. So we are flat. Really nice trade on SPY. And we're waiting for our next overnight pop trades. We will take a look at those tomorrow afternoon into Friday. SPY has Monday, Wednesday, Friday expirations. All other stocks with weekly options have Friday expirations. So tomorrow afternoon, we'll be looking for our next round of overnight trades. And we would love to have you join us. We've talked about this here over the past couple of sessions. We have just released another round of our overnight pop trade service. If you'd like more details on how you can participate in the next round of setups, feel free to send me an email, mike@netpicks.com. More than willing to connect and help address any questions you might have and see if there's a good fit for you with these overnight trades that just continue to perform really, really well for us. Now, let's shift our focus now over to what we're expecting the rest of this week as far as new setups go. We've been talking about how the Nasdaq has been weak, and as I'm speaking here, I'm looking at my other screen, and it looks like the Nasdaq just made a new low on the day. Yep, I did. So just made a new low on the session. So we're going to start out with the chart of QQQ. This is the Nasdaq ETF on the 195-minute chart. This is the chart that we typically use to gauge our entry and exit points. Well, we can see that the noisy pattern has been in place for about a week now. Okay, I mean, it's just been back, forth, without a ton of follow through. The area of support that QQQ is getting stuck on is right around 312. Okay, we're currently sitting right on top of that level as I speak. If that level breaks, we could get another wave to the downside. One more wave to the downside. That could potentially be the washout move that we need for a near-term bottom. We are oversold, and here's how I quantify that. Take a look at our red and yellow histogram down at the bottom. Just recently, over the past few days, we have had those bars plot yellow. That indicates an oversold extreme. It indicates price reaching between a 1 and a 2 standard deviation move on the downside. It does not mean price cannot continue to head lower. It just means it's not statistically probable. When you start to see this type of a pattern, you start to see the yellow bars on the pulse, it will typically lead to a period of consolidation or a reversal in the other direction, in this case, to the upside. I am potentially, over the next few days, looking to put on a neutral to bullish trade on the Nasdaq ETF, looking for that potential rotation out of the energy and the financial sectors back into tech. So how would I play that? If I'm looking for a bullish trade, it's natural instinct just to say, hey, let's just buy long calls. In fairness, that is a way to put on a bullish trade. The problem with that approach is it's far too aggressive. If I buy a long call, QQQ better move to the upside and it better do so quickly. I'm not looking to be that aggressive. We've talked about it now here for the last 20 minutes. This market has been very, very choppy. I am not necessarily expecting a strong bounce back up to the highs on QQQ. I'm more expecting a choppy consolidation phase or even a small bounce. And the way that I would rather play it is to potentially look at selling an out of the money put spread. So let's go over to the trade page. And let's go ahead and take a look at what expiration cycles we have available to us. I have been trading a lot of the April monthly options here of late. Those are the options with 44 days left to expiration. In most cases, I'm trying to go with the expiration cycles that have between 20 and 60 days left to expiration. That's typically our sweet spot. I am willing to go less than 20 days to expiration, but the only time I'm really going to do that is if I have a strong directional opinion on that stock, or if I'm using a credit spread, because the credit spreads will allow me to take advantage of the bigger time decay. So what I'm going to look at doing, we could do this in April. I wouldn't have a problem with it. I'm actually going to go out to, let's take a look at the March 26 weekly options. Those are the ones with 23 days left to expiration. I'm going to go to the put options on the right-hand side. I'm going to go to the out of the money put options. I'm going to load up some additional strikes here. And I'm going to go to, let's start out with the 300 put. I'm going to right click on the 300 put, go to sell, and I'm going to select vertical. That is going to pop up an order down at the bottom where I am selling the 300 put, and by default, I'm buying the 299 put at the same time. I am going to change that 299 put to 298. I'm changing that because I want a couple of reasons why. Number one, I want to collect more premium. Okay, if I were to just use a $1 wide spread, I'm only able to collect 20 some cents. If I use a $2 wide spread, I can collect 50 cents. My whole goal with the credit spread, I am okay risking between 2 and 3 to make 1. I can make the numbers work with that ratio. If I start to risk 4, 5, 6 to make 1, it becomes much more challenging, and that's where most traders get into trouble. So by collecting closer to 50 cents, if I collect 50 cents on this trade, I'd be right at risk 3 to make 1. I'd be collecting 50 cents or $50 per spread. I'd be risking $150 per spread. Now, the beauty here is this is a fully risk-defined trade. If the market doesn't bounce, if we do get that washout move lower, the most I can lose if I am dead wrong is $150 per spread. Very reasonable, right? The most I can make, I am giving up my home run profit potential because my max profit on this trade is $50 per spread. Okay, so if we do get a big move higher, there's far more profit potential with a long call. It's just a higher risk, higher reward type scenario. I want to be more conservative. So here with the spread, I have a lower profit potential, but a higher probability of success. I have a higher probability of success because I have 5 ways of making money on the trade. I make money if QQQ moves up, down, or sideways, doesn't matter to me, as long as price stays above 299.5. That break-even point, it is calculated by taking my 300 put. I'm subtracting the 50 cents that I collect to put the trade on, and that gives me the break-even. Current price of QQQ is trading for just under 312. I've got about a $12 cushion here where I can be wrong and QQQ can continue to move lower and I'd still be okay. The only move that hurts me is a big move below 299.5. We're not expecting that because price is already oversold. We're already between a 1 and a 2 standard deviation move on the downside. Doesn't mean price can't move lower from here. It just means it's not statistically probable. So up, down, or sideways, we are okay as long as price stays above 299.5. We also make money from time decay adding up. Every day that passes, that helps us. And we make money from volatility decreasing if it does. In theory, if QQQ decides to bounce and move higher, volatility is going to contract. That would help us. It would allow us to make money faster on the trade. If I get filled at 50 cents, that is my max profit. The only way that I can book that max profit is if I hold all the way up to expiration. Not something I am looking to do. I would rather close it out when I can keep between 50 and 75% of the max profit. So if I can buy the spread back for between 12 and 25 cents, that would allow me to book 50 to 75% of the max profit. So that's the plan of attack for managing the trade. Now, another one that's on my radar, let's go ahead and switch the chart over. This is FXI. This is the China large cap ETF. And actually, let me switch this. Switch it over to the 130-minute chart. These are the 2 time frames that I use most often in my own trading. I love to use the 195-minute. I love to use the 130-minute as well. So this one, a little bit faster moving. It's going to be a little bit more sensitive to directional movement back and forth. And when we take a look at the chart, you can see on the 130-minute chart, just like QQQ, we have these yellow bars on the pulse. indicating an oversold extreme. Doesn't mean price can't move lower from here. It could. It's just not statistically probable. Typically, when we see this type of a reading on the pulse, it will lead to a period of consolidation or a reversal in the other direction. Look what happened the last time we had an overbought extreme back in January. What happened to price? We chopped sideways and we reversed lower. So it's a very repeatable pattern. It does not mean it's going to be perfect. There could potentially be another wave to the downside. So I'm cautiously looking for a bounce. Just like we talked about on QQQ, we're going to take a look at selling and out of the money put spread here. What you could do, and we've already started to see it happen here today, in order to wait for confirmation, just because we get an oversold extreme doesn't necessarily mean we want to jump right into a trade. If you wait for price to confirm, we can do so by waiting for price to move above the 8-period exponential moving average. That's that red and blue line here. But we have seen price move above that level. You could potentially wait for a daily close above the 8 EMA. If that's the case, you would potentially wait to put this trade on tomorrow. I'm perfectly fine with that. Just trying to wait to see if price is indeed ready to bounce. I'm not looking to buy a long call here, just like we talked about on QQQ. It's too aggressive for my taste. I want to be a little bit more conservative, and I want to use a more forgiving type trade. So let's go ahead and jump back over to the trade page. Switch the symbol from QQQ to FXI. And I'm going to go out to the April monthly options with 44 days left. Just trying to mix up my expiration cycles, trying to diversify as much as we can. So let's go ahead and take a look. I'm going to take a look at selling the 48-46 put spread. All that means is I'm selling the 48 put and I am buying the 46 put at the same time. Now, there's a $2 difference between the strikes. I just mentioned on QQQ, I'd ideally like to collect enough where I can be in that risk 2 or 3 to make one scenario. Here's the problem. I can only collect 44 cents on the spread. If I only collect 44 cents, take a look at my risk reward. I'm approaching risk 4 to make one. That does not meet my criteria. I have to collect 50 cents at a minimum. So the trade as we currently have it set up does not work for me. It does not meet my criteria. How do we make an adjustment? How do I potentially tweak the trade to meet my criteria instead of just throwing it out the window saying, yep, we're not trading FXI. In order to collect more premium, I have got to move my strike prices closer to the current stock price. I would have to move them to 49 and 47. So now I'm selling the 49 put and buying the 47 put. I'm trading two options at the same time to make sure I'm in a fully risk-defined trade. Now look at the premium that I'm collecting. Now I'm collecting 60 cents. Now it makes sense because if I click on the order confirmation box, now I'm only risking 140 to make 60. Now I'm in that risk 2 or 3 to make one scenario. Now it makes it more attractive to me. If I collect 60 cents, that's the most I can make on the trade. I make money on this position as long as FXI stays above 48.40. That break-even point that I'm circling right there, that is calculated by taking my 49 put that I'm selling. We're subtracting the 60-cent credit that I'm collecting to put the trade on. So now I don't care if the stock moves up, down, or sideways. We're okay in all three scenarios as long as it stays above 48.40. We also make money from time decay adding up and from volatility decreasing. So again, we've got 5 ways of making money on the position. If we're dead wrong, we're out. If we're dead wrong, and we hold all the way to expiration, we're out $140. Very reasonable trade on the risk side. Now, I've talked about this in some of our recent webinars. A lot of times people look at this and say, okay, that ratio it's not attractive to me. Well, it's attractive because we've got 5 ways of making money on the trade. And then also it's actually slightly better than that because I am not in most cases going to take a full loss. The only time I take a full loss is if I hold all the way up to expiration and FXI continues over the next 44 days to move to the downside. Not expecting that. If we do see a continued move to the downside and I want to close the trade out, I can certainly do so and take a partial loss. Okay, so our ratio when we put the trade on is between risk 2 and 3 to make one. It's actually going to be better than that should we close the trade out early for a partial loss. So collecting 60 cents, we'd be looking to close the trade out for between 15 and 30 cents. If I can buy it back inside of that range, that would allow me to keep between 50 and 75% of the max profit. That's another trade on FXI. So honestly, guys, the way that I am approaching this market here today, I am not really interested in a whole lot of new long calls and long puts. Okay, I haven't found anything that's jumping out at me on the long option side. The reason for that is just we've seen a lot of back and forth, a lot of chop, a lot of big moves intraday without follow through. The vertical spreads that we talked about today, specifically with the credit spreads, they are more forgiving. They are going to allow us to make money in more types of market scenarios. In this type of environment, until we start to see more of a clear trend develop, I'd rather be more conservative. That's my approach. When I get into these types of markets, we can still make money. We're just not shooting for those home run returns right now. Not this week, not with what we're seeing, not with this pattern right here, not with this choppiness right here. It's just not the environment to look for those home run trades, in my opinion. If we start to see one of these support or resistance levels break, like we talked about a few moments ago, that could very well change our outlook, over the next 3-4 days. But we want to see price action confirmed first. All right. So if you have any questions on the trades that I just got done talking through on QQQ or FXI, let me know. Both of those trades, I do not like to place credit spreads midday. I typically like to place those trades during the last 30 to 60 minutes of the session. Better volume at the end of the day allows us to see, do we get any type of buy the dip scenario over the next few hours? So those are trades that I would revisit later on this afternoon to see if we can get filled. All right. So if you don't have any other questions, I'm going to start to wrap up for the day. I'll do my best to try to jump back on Friday for our weekly recap. We'll take a look at our overnight pop trades again on Friday. It'll probably have to be an earlier session on Friday. I do have to be on the road traveling Friday afternoon. So I'll do my best to try to jump on Friday. We hope to see you here for our next live session. If you have any questions in the meantime, feel free to send me an email, mike@netpicks.com. Otherwise, I'm going to wrap up for the day. Enjoy your afternoon, everybody. And I will talk to you on Friday for our next live session.